In this session, we are going to have a look at the interrelatedness between financial statements. Therefore, you should be able to understand the interrelatedness between these statements and then to prepare the financial statement from either a pre-adjustment trial balance with adjustments that you then do incorporate, or from a post-adjustment trial balance where the adjustments have already been incorporated according to the IFRS for SMEs. So when we look at financial statements, the first statement that we will prepare is the statement of comprehensive income, or the full name would be the statement of profit or loss and other comprehensive income. The purpose of that statement is to determine the profit or the loss for that year. A profit will increase the equity, and because profit will increase equity, it will flow into the next financial statement, which is the statement of changes in equity. The statement of changes in equity shows the movement in the balance of equity. So we will start the statement of changes in equity with the opening balance for capital, plus the profit that comes from the previous statement, that one there, plus contributions. Now these are additional contributions that the owner has made to the business, capital contributions, minus the drawings. This will then give me the closing balance for equity for this particular financial period. The closing balance for equity is then transferred to the statement of financial position, because the statement of financial position shows on a particular date a snapshot of all three of these elements: assets, equity, and liabilities. So to recap, these three statements are related. They have an interrelation between the three. We start with a statement of profit or loss and other comprehensive income. This produces the profit or the loss for the year. Since profit or losses for the year will have an influence on equity, we transfer our answer to the statement of changes in equity. The statement of changes in equity shows the movement in equity, taking the opening balance of capital, or the equity that we had last year, plus contributions this year, plus profits this year, or if we've made a loss, we will deduct the loss, minus drawings. That will give me the closing balance for equity. The closing balance for equity is then transferred to the statement of financial position, and this is where I see the equity for this year. If we look at the statement of profit or loss and other comprehensive income, this is a very simplified example. So we have our revenue and we have our cost of sales and gross profit, but I want you to have a look at the profit that we've calculated for this year. This profit will be only pertaining to this financial year, the last 12 months. But when I prepare the statement of changes in equity, that 45,000 Rand will be incorporated in the statement of changes in equity since it increased my equity. We will start in the statement of changes in equity at the beginning of the year. These amounts will be given to me, and then we have additional contributions by the owner, capital contributions. We will deduct the drawings of this year. The statement of changes, the statement of comprehensive income would have given me this profit for the year, and this is the amount that we will then use in the statement of financial position. So in the statement of financial position, let's first have a look at the equity. This amount is there for the closing balance, and this is the result that we've received by doing the statement of changes in equity. For property, plant and equipment, we are going to have a note, the same for every class of my current assets. We will also have a note for every class of my liabilities, but the equity will not have a note because this is calculated in the statement of changes in equity.